Close your eyes for a second and picture who owns the world. You might imagine tech billionaires, oil barons, governments, maybe banks with glass towers. Now here's the uncomfortable part. A massive slice of the world you live in, the companies you work for, the homes you rent, the roads you drive on, is owned by institutions you never see, managing money that isn't even theirs. Your pension fund, and if you don't have one, someone else's pension fund. This is the quiet truth of modern capitalism. Pension funds don't just save for retirement anymore. They own everything. And that fact is shaping your future in ways most people never notice. Let's slow this down. Right now matters because we're living through the largest retirement experiment in human history. Aging populations, longer lives, fewer workers, and trillions of dollars that must earn returns every single year or the math breaks. Globally, pension funds control over $50 trillion. That's not a typo. That's more money than the GDP of most countries combined. And unlike hedge funds or day traders, pension funds don't get to stop. They can't sit out. They must invest constantly, forever. So what do? They buy the world. It didn't start this way. Decades ago, pension funds were boring. They bought government bonds. Safe, predictable, low drama. Retire at 65, get a check, end of story. Then inflation hit. Rates fell. People started living longer. Suddenly, those safe bonds couldn't pay the bills anymore. Promises stayed the same, returns didn't. So pension funds made a deal with risk. They moved into stocks, then real estate, then private equity, then infrastructure, then things most people don't even realize are owned. Airports, toll roads, power grids, warehouses, data centers, farmland. If it produces steady cash over decades, a pension fund wants it. Here's the simple logic. A pension fund doesn't care about hype, it cares about duration. It asks one question: can this asset quietly pay us for 30 years? That's it. That's why pension funds don't trade, they accumulate. They don't chase trends, they become permanent owners. When you hear institutional investor, this is what that means: a buyer who never really leaves. And that creates a strange dynamic, because pension funds aren't trying to innovate or disrupt or grow fast. They're trying not to fail. They need predictable cash flows to pay retirees who are already alive, every month, on schedule. Miss that, and it's a political crisis. So pension funds push companies to behave differently. Less risk, fewer experiments, more buybacks, more cost-cutting, more stability. From the outside, it looks like discipline. From the inside, it often means slower growth and fewer big bets. Now let's talk about the math no one likes to say out loud. Most pension systems assume annual returns of around 7%. That number is not magic, it's survival. Drop below that for long enough, and the system becomes underfunded, which is a polite way of saying there isn't enough money to pay what was promised. Here's the problem. In a low-growth, low-rate world, 7% is hard, really hard. So pension funds stretch. They move into private markets where prices are harder to see and assets don't get marked down as often. They buy illiquid things and pretend volatility disappeared. It didn't. It just stopped being visible. That's the hidden mechanism. Public markets show pain immediately. Private assets show it slowly, quietly, sometimes years later. This creates an illusion of stability. And it's why pension funds now own huge chunks of companies you thought were private, even though your paycheck depends on them. It's also why housing feels different. Pension funds are some of the largest buyers of rental homes, apartment blocks, and commercial real estate. Not because they want to be landlords, because rent is predictable. Long-term leases look like bond payments, except higher. So when you compete for housing, you're not bidding against a family, you're bidding against a retirement obligation. And that obligation never sleeps. Here's the irony. Pension funds exist to protect regular people in old age, but their scale changes the world those same people live in while they're young. Higher asset prices, lower yields, more ownership concentration. The safer pensions try to be, the more they push risk outward, toward workers, toward renters, toward taxpayers. This is where hype and reality split. We're told markets are driven by innovation and entrepreneurship. In reality, a huge portion of the market is driven by institutions that hate surprises. They don't want disruption, they want consistency. That's why entire industries feel frozen, why productivity gains don't show up in wages, why profits flow upward but risk flows down. Now zoom out. What happens when everyone retires at once? When cash starts flowing out instead of in? Pension funds are built on a quiet assumption that new workers will keep paying in while old workers withdraw. But demographics are shifting. Fewer workers, more retirees, longer retirements. That means pension funds may eventually become net sellers instead of buyers. And when permanent owners start selling, markets behave differently. Liquidity matters, prices move faster, volatility returns. This doesn't mean collapse tomorrow. It means the invisible stabilizers of the system may not be permanent. And here's the final uncomfortable thought. Most people don't realize they're already inside this system. Your retirement, your rent, your job, your taxes, all connected through giant pools of money chasing steady returns. Pension funds don't control the world out of greed, they control it out of necessity. Which raises a quiet question worth sitting with. If your future depends on institutions that must own everything to survive, what happens when owning everything is no longer enough?